Hey, I'm Jason, and this is Supply and Demand Daily, where I tell you what we learned about the economy today. I'm going to give you an update on the U.S. government bond market, and then we're going to get into foreign trade. The balance of foreign trade, that's goods and services exported and imported, was released today by the Bureau of Economic Analysis in partnership with the Census Bureau. Then I'm going to talk about consumer credit. All right, so that's what I'm going to go over, and this isn't the craziest data in the world, nothing groundbreaking here, and the other thing I want to point out is that both of these are 2 months delayed. So when we look at this data, we're going to be looking at April of 2022 rather than the rest of the data that we'll be looking at this month, most of which is going to be for May, right? So in order to do all that, I'm going to go ahead and get out of the way, and we will go ahead and get started. Bond market update. A few weeks ago, I predicted that the top that we will see in the bond market, and that is specifically related to the 10-year Treasury yield, which is an important benchmark for U.S. government bonds. So the 10-year Treasury yield, I predicted that we would only reach a rate of 3.18. That was the rate towards the end of April, might have been early May. I don't remember exactly what the date was, but that is this peak that I'm showing on the screen right here, and that is about 3.18%. We bumped back up against that, settling around 3%, or I think just above 3% yesterday, and came back down from there. So far, I'm not wrong, and again, my prediction is that for this interest rate cycle, financial market cycle, whatever you want to call it, in other words, between now and after the next recession, we will not again see a rate higher than 3.18% in the U.S. government bond yield, which is also referred to as, you could think of that kind of like an interest rate. It's not exactly an interest rate, but it is a form of expressing the relationship between price and interest rate on the U.S. government bond. Yields are, again, probably some of the most highly watched financial indicators in any of these markets, so especially the U.S. 10-year. And then another measure of optimism in financial markets, we have the spread between the 10-year Treasury and the 5-year Treasury. So the U.S. government issues its bonds at many different maturities, and so two of those are the 10-year and the 5-year. And I've sort of explained this before, but kind of the way to look at this is if the 10-year Treasury is higher than the 5-year Treasury, right, then that means that returns on invested capital are expected to be higher in the future than they are now. So it's a sign of optimism in financial markets. And then another way to look at this yield chart is when you see this yield go up, it's basically the inverse of price. And when demand goes down, price goes down, and so that means that the yield goes up. And so when we see the government bonds yield going up, that's actually a good thing, because what that means is that the investment community, in other words, commercial banks, investment banks, and non-bank financial institutions, it means that they are choosing other assets, maybe lending money directly to companies and startups, or choosing to buy the bonds of other companies, both foreign and domestic, instead of the ultra-safe government bonds. And that's a good thing, because in order for the economy to grow, we want the managers of capital, or the people in charge of lending money, to be lending money to actual companies that are going to invest in productive enterprises that create goods and services for society, instead of pushing all of their funding into government bonds, lending it to the government, because that doesn't, whatever you're feeling about government running deficits is, that doesn't create a whole lot of goods and services or productivity that is going to benefit society as a whole. So that's how we think about these things, and that's why yields increasing is actually a positive sign for economic growth, and yields going down is really a negative sign for economic growth. Just wanted to go over that. And then the 10-year, 5-year spread, what I was getting at earlier, is still flirting with negativity ever since basically March of this year. So it inverted and went completely negative back in March, and then it's just been playing with that zero level, kind of straddling it over and under and over and under. So that's where we are with the 10-year, 5-year spread, and that's been basically the behavior of the other spreads in the bond market as well. Not exactly. There's a lot more that goes into that, so that's more than I have time to explain here. But now I want to get to the balance of foreign trades. The foreign trade balance was released today, and the first thing that I'm showing in this chart here is the services component of that foreign trade balance. So the foreign trade balance is a combination of both goods trade and services trade. That is the flow to and from of goods and services across the United States border, if you live in the United States, obviously. So that's what we're looking at. Now, this green line up here, that is the balance of trade in services, and what you'll see here is that is above zero. What that means is that the United States is exporting more services than it is importing services, so we're providing more services to the rest of the world than we are importing, and the U.S. is by and large a services exporter. We have a highly educated economy, and so, it behooves us to export our services, and there's a lot of people who want it. The demand for our services is kind of a gauge, or can be looked at as a gauge, of the economic health of countries across the various ponds, across the Pacific and the Atlantic Ocean. And so what it means when the services exports go down is that maybe income is falling, or there's less willingness to pay for services in our trading partners, whether that's China, Japan, the United Kingdom, other countries in Europe, Brazil, etc. And then, so what we have in this purple line then is the balance of trade for goods. And so if this line is negative, as it is, then that means that we are importing more goods than we are exporting. So the United States economy is usually a goods deficit holder, a goods deficit haver, if you will. That means that we spend more on goods than we make by exporting goods to the rest of the world. And a lot of other countries have a trade advantage in producing a lot of different things over the United States. And a lot of that is entangled in how our financial system works in general. But one thing while we're on this subject, or the next thing that I want to list after that, is that what this is called is the current account balance. So you take the export trade and you take the goods trade and the services trade, and you add those things up, and that's what's called the current account balance in when you're talking about trading economics and stuff like that. This is the current account, and when we have, obviously, if you look at this last chart here, you'll notice that the purple gap is a lot larger than the green gap. And so when you put these two things together, on net, we have a current account deficit. So if you have, if you're importing more goods and services than you are exporting, when you put them, when you put the two together, then you end up with what's called a current account deficit. And if you are exporting more than you are importing, when you put goods and services together, that means you have a current account surplus. And so what this means is that we are essentially importing more goods and services, mostly goods, as we saw previously. And in order to do that, we have to export a great deal of dollars. We have to export a lot of income. Now, how does a country do that? If, our income from the rest of the world is lower than what we are paying the rest of the world for our goods and services. So how do we do that? Well, it kind of works the same way that a household would have to do it. So imagine a household, and in the top section here, we import goods and services from the rest of the world, and that's not a bad thing. I produce financial services, but guess what? I can't eat financial services, and so the things that I do eat, I have to import from the community at large, the United States and the city and the Texas economy and the global economy, right? There's nothing particularly wrong with that. And then we export our services, our goods and services, to the rest of the community, and in order to import the services, we pay dollars, and in order to export the services, what do we get in return? We receive dollars. Now, if I'm a household and I'm receiving fewer dollars than I'm actually spending to bring in goods and services from the rest of the community, what do I have to do to make up that shortfall? Well, I have to go into debt. Maybe I run up a credit card, or maybe I take out a personal loan from a bank that doesn't ask too many questions, because that's really the only situation in which they would allow me to finance those kinds of deficits. But the way to think about a trade deficit on a household level is I'm sending out in income in dollars more than I'm bringing in. So I'm basically running up a credit card. And is that necessarily sustainable? Absolutely not. But one reason that we in the United States are able to do it is because we happen to produce the world's reserve currency. So the dollar is the world's reserve currency, and so there are a lot of countries, a lot of savers and investors in the world who really want dollars, and they want the kinds of assets that are denominated in dollars. So basically stocks and bonds. They want those kinds of assets, and so they are willing to pay us in goods and services in order to get those kinds of assets, which a lot of those are corporate bonds and U.S. Treasury bonds, especially a highly valued savings vehicle for companies and institutions across the world. That's how that works. Any current account deficit has to be financed with some sort of liability. What that means is you're either selling stocks, selling bonds, or other kinds of assets. Maybe a foreign investor may buy land in the United States, or buy factories, or buy other kinds of real estate in the United States. So that would provide the income for whatever company previously owned that to be importing goods from other countries. Okay, so now when we take that into account, all I've done here is to basically take the opposite end of that trade deficit. So the implied foreign liabilities, whenever we run these current account deficits, we have to export some kind of liability. When I say liability, I really just mean a promise to pay X, right? So I'm either talking about stocks, because with stocks are the obligation to pay, dividends, and to, whatever part of the profits are going to be distributed in that form, as well as any assets that are left over in the event of bankruptcy. So that is considered, when it comes to foreign trade, that's considered a liability. So we'll export stocks, and then we will export our bonds, which means other countries that like to buy our debt, that like to buy our bonds, we are obligated to pay them in the future, because that's essentially what debt is. So, and all I've written to describe here is to finance larger outflows. Then there are inflows. Individuals, companies, and governments must sell assets. That takes the form of physical capital. That's the real estate that I was discussing earlier. And then we have stocks, investment funds, we have loan obligations, and bonds. And this trade deficit was $87 billion in April. So no small number. And you can infer from that that approximately, somewhere around that number was exported in the form of liabilities in order to finance all of that spending. So foreigners bought approximately 87 billion of some combination of our stocks, bonds. This also includes financial derivatives. If you know anything about those, financial derivatives are included in that financial account makeup for that trade deficit. For the current account deficit. Need to make sure I use, uniform terminology here, but anyway. So the other thing that I wanted to point out is that remember how I said that the sort of a way that you can gauge the economic health of your trading partners, or of the United States' trading partners, specifically, is how much of our services they are importing, which from our perspective, that would be how much in services that we are exporting. And so that's what I have in this chart here. By the way, all of these y-axes are in billions of dollars. So, or excuse me, millions of dollars. So if you see this 20,000, that means 20,000 million, which is 20 billion. You can apply that to each of these different charts that I have displayed. Going all the way back. So, and I'll let you know if that changes. But services imports, and what I mean by that, oh my gosh, that's a big no-no. Throw this imports word out here. What I really mean by this is exports. So services exports, that's our net exports, are still lower now, or in the most recent month that we have data for, which was April, than they were in January 2018. So services exports reached about $26 billion on the month in January 2018, and now we're looking at a little over $20 billion. So that doesn't necessarily bode well for the economic health of our trading partners overseas. And if you look at their data, which there is some of that data coming out later on this week and later on this month that we'll be discussing on the supply and demand dailies, and that tends to corroborate that story, right? So there's been a lot of economic weakness ever since 2018, as it turns out, and there was even big long bear market in stocks between the end of 2018 through 2019, all the way into 2020 when everything sort of reversed. So yeah, that's definitely doesn't paint the prettiest picture of the economic health of our trading partners. But moving on from there, consumer credit. So every month, the Federal Reserve Bank will release consumer credit issued for 2 months ago. Again, we're talking about April of this year, whereas we would usually be talking about May. Now, consumer credit is kind of an important indicator because in this financial system, we do have a financial system that is based on debt. And all that I mean by that is that purchasing power is granted in the form of new loans. And so when we talk about consumer credit, what we're really talking about is new money created by banks in order to finance consumer spending. And a sign of the health of the consumer, this tends to drop pretty rapidly during times of economic distress. I'm talking specifically about recessions, depressions, whatever you want to call them, times when the economic activity drops significantly. And that's what we see here with the big old drop in the recession of 2020. And as you can see, consumer credit turned around pretty rapidly after that. The Federal Reserve did a lot to minimize the damage to the financial industry and keep credit flowing. And so we had a pretty strong bounce back in consumer credit, even though the economy was really so bad for those couple months. I mean, absolutely terrible. But the kinds of loans that we're looking at here when we say credit, we're talking about automobile loans, we're talking about houses, credit cards, personal loans, all of those outstanding. So it is a stock of consumer credit, but what I'm showing here is a measure of the flow of consumer credit. And so this is the 3-month annualized percentage change. And what that means is I take the percentage change over 3 months and multiply it times 4, because that would give you a rough estimate of the annual if the same thing were to happen for, an entire year, if it were to grow at that same approximate rate for an entire year. And we saw a pretty big number, a relatively large number in April of this year of 8%. Keep in mind that these figures are not inflation adjusted, so a lot of this could be simply that it takes more credit to acquire the same amount of goods and services on the part of consumers, especially for houses, right? So when the supply of housing is really low and the prices of houses are very high, then it takes way more credit to get the same amount of house. So that is definitely a potential driver behind these large consumer credit numbers for sure. And then just for, buying goods and services on a credit card, it takes more credit to, acquire the same number of goods with the inflation that we've seen. All right. So, a more interesting perspective that I wanted to point out, though, is a long-run chart. So this chart goes all the way back to 1947. The ones that I've shown so far are only about 5-year charts, right? This one goes all the way back to 1947, and what it is you'll notice the y-axis is percentages, and so this is consumer credit outstanding as a percentage of GDP. GDP is the combination, it's gross domestic product, and that is basically the sum total of all spending on new goods and services produced in a given year in the entire economy. So it's government spending, investment, plus consumption, and then net exports. That makes up GDP. So it's all of the spending, and so it is an appropriate adjustment mechanism for something like consumer credit. So it brings that value into real terms. And what I just found really interesting that I wanted to share with you is this display of really how much more consumption-based the United States economy has become in the roughly 70 years since this data set began. So we started this time period with a consumer credit outstanding being less than 5%. So it was about 4% of all spending in a year in the economy in 1947, and then we peaked in that level in 2020 with a level of about 21%, and a lot of that is because GDP just dropped significantly in 2020, right? So that'll have an effect on this as well. But now we're sitting at a level of about 18.4%, which is about a little under 5 times, 4.5, 5 times where it was 70 years ago. And so this chart really just tells you how, again, just how much more consumerized, consumption driven the economy has become, at least in the United States, over this long period of time. A lot less investment driven, a lot more consumption driven. And how sustainable that is, time will only tell, because consumption essentially means the using up of resources rather than the production of new resources. They can be produced or be used to produce more stuff, more goods and services for the general population. So how sustainable is a trend like that? Yeah, remains to be seen. And one of the ways that we finance this trend is what we talked earlier, which is, exporting our liabilities to the rest of the world in the form of taking on debt and selling stocks in our enterprises. So with that, that's about all I have for you today. Tomorrow, I'm going to give you an update on the Yemen war, because it actually, and I'll tell you exactly what the Yemen war is and why it started, which is kind of important right now, though it's kind of getting overshadowed by what's happening in Ukraine. But the reason that I'm going to give you an update is because it looks like it might actually come to an end maybe in the next several months. My fingers are definitely crossed for that, because I don't like war, and I think war sucks, especially when there's really no good reason to be attacking somebody, and that seems to be the case in Yemen. So I'm going to give you an update on that, how we got into this mess and how it looks like we may be getting out. And when I say we, I just mean the United States armed forces and thereby the United States taxpayer. So I hope you enjoy the rest of your, God, what day is it today? Tuesday, June 7th, and I'll be back tomorrow with another Supply and Demand Daily, which I hope you'll join me for. Thank you very much, and have a good one. Thanks. Goodbye.